Hello, everybody. Firstly, I'd just like to wish you the warmest of welcomes to this webinar where I'll be describing the basics of the foreign exchange market, or what we call Forex, to you. My name is Sasha, and I'm a financial analyst from the research department at Fortrade. I'm really happy to see there is so much interest in our webinars, and this one in particular, so thanks for joining me. In my opinion, it's really important to have an understanding of Forex in order to have the confidence to make trading decisions. So I'll be covering everything you need to know in plain English. If anything is unclear, you can write me a message during this webinar. If not, feel free to contact one of our account managers. Before I go any further, please take a moment to read our risk warning disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. And please stick around, because towards the end of the webinar, I'll be presenting what we call a market opportunity to you and our special offer that I'm sure you'll be interested in that will significantly enhance your trading experience. Let's talk about the Forex market. I'm going to explain how it all works, how to trade, the terminology, and perhaps most important question of all for you, why trade in Forex markets? So, what is Forex? Well, let's create a story to show you how simple it is. Perhaps you've arrived at an airport in a foreign country and realized you don't have any local currency in your pocket. Either you go to the first cash machine you can find, or you can find an exchange office to change your money into local currency. While waiting in a queue and possibly cursing yourself for not sorting this out ahead of time, you might find yourself looking at an exchange rate board. You can see different rates for different currencies. Let's say you have 10 British pounds in your pocket and you're in Japan, and the exchange rate is £1 for 140 yen. You make the exchange and now have 1,400 yen in your pocket. You have just exchanged one currency for another. Or to be exact, you have sold pounds and bought yen. Congratulations. The chances are you've probably already participated in the Forex market. In a nutshell, the Forex market is the market in which participants are able to buy, sell, exchange, and speculate on currencies. The foreign exchange market, or FX, is the largest financial market in the world, where you can trade currency pairs and on other products such as indices, stocks, and commodities. In the world of Forex, these products are called contract for difference, or CFDs. A CFD is a contract between two parties, a buyer and a seller. It is only the price of the instrument that the buyer and seller are trading with. This is a benefit since nobody has to own anything in order to trade. Participating in the Forex market involves less paperwork and involves less cost to you than, for example, buying shares. To give you another example, if you wanted to buy one share in Apple, it would currently cost you around $175. But if you want to trade on Apple and many others such as Facebook, through trading CFDs you can do this with a much smaller outlay. The foreign exchange market is huge and has a trading volume of $5.3 trillion a day, so the opportunities are boundless. So how does it work? Well, Forex isn't a centralized market, and it exists whenever the trade of two foreign currencies is taking place. Another advantage the market has is that it's open 24 hours a day and 5 days a week, Monday to Friday. You can trade anytime you want during the working week. All types of people or institutions are trading. Central banks, ordinary traders, retail traders, and speculators are all busy trading currencies and other CFD products. What's a currency pair? Well, this term sounds complicated when it's actually very simple. A currency pair is the value of one currency expressed in terms of another currency. The example you are looking at on the screen shows the euro-dollar currency pair. In our case, the first currency, the euro, is what we call the base currency. The second currency, the dollar, is called the quote currency. Other currency pairs include the pound-dollar currency pair or the Australian dollar-euro currency pair. In fact, any two traded currencies you can think of are currency pairs. It is one currency's value in relation to one other currency. Let me provide an example of how a currency can be defined with Forex in mind. Let's say you have a euro and you're thinking like a Forex trader, but you haven't traded before. You essentially have a very small share in the Eurozone economy in your pocket, and are counting on the fact that the European Union economy is doing well and will do even better in the near future. You believe that the value of that euro will go up because of the strength of the Eurozone economy. But let's say that some serious economic problems are announced in EU economies. You then decide that the European Union's economy doesn't look as strong as you thought, and that the American economy is looking like it's going to grow considerably stronger. So you decide to take that euro and execute a sell order on the euro-dollar currency pair. You now have the equivalent value of that euro in dollars. And you've done this because you expect that the strong US economy will mean that the value of the dollar will grow further, and because you believe the weakness of the Eurozone economy would have reduced the value of your euro. This is a very basic example, but hopefully it will help you to look at currencies in a different way. This is how traders view currencies and the way they react upon receiving information. If you take a look at the screen, you can see a list of the most popular currency pairs. Basically, it's the currencies of the biggest economies in the world. You can, of course, trade on all of them. So, if you want to trade currency pairs, it's important to know what pips are and what the spread means. In the example in front of you, you can see that if you have €1 and want to trade it for dollars, you will receive $1.4745. That dollar amount you receive is called the bid price, and you are selling your euro for this amount. If, on the other hand, you want to buy €1, this is what we call the ask price. It will cost you $1.4748. The spread is the difference between the buying price and the selling price. It is the commission which you pay as a currency trader. To take a unit of measurement, in this case a pip or pips, express the difference in value between two currency pairs. Since most major currency pairs are priced to 4 decimal places, the very smallest change is of the last decimal point. A pip is the smallest unit of a price move that a given exchange rate can make based on market convention. In our example here, the price shows that the euro-dollar pair is trading at 1.4745. But if it moves up to 1.4746, this means that the price has a difference of 1 pip. If the price of the dollar moves from 1.4745 to 1.4755, that is a change of 10 pips, and so on. Next to the bid price, you can see the spread, which is 1.4748. So the spread in this example is 3 pips. Leverage is important to understand. It's one of the great advantages in the Forex market. Basically, leverage gives the client the opportunity to use a small amount of invested money to perform a higher volume of trading transactions. For example, I decide to open a real trading account with Foretrade and make an initial deposit of $500, and I'm looking to trade a currency pair. Leverage is commonly up to 200 to 1. So let's say this is my leverage on the euro-dollar currency pair as well. Thanks to leverage, rather than only having $500 to trade with, I will actually have the ability to perform a trade equivalent of up to 100,000 US dollars. This means a relatively small starting deposit into your trading account of only $500 can potentially make great gains. However, it's important to trade responsibly and in an informed way, since the market can turn against you. Of course, we at Foretrade aim to give you the best chance of success trading, and it's the job of our research department to provide analysts to provide an analysis of the highest quality to our senior account managers, who you will have access to once you have made a deposit, and they will do everything they can to help. There are many other advantages of trading in the Forex market, but as this is an introduction to Forex, and I'm sure your time is valuable, I will summarize. Extremely high liquidity. To break this down, this means that there will almost always be somebody in the market who'll be willing to trade with you. Leverage, I've already spoken about. You don't have to invest a large amount of money to perform a high volume of trading transactions. The market is open 5 days a week and 24 hours a day. Double side trading. This means since you're trading with price, you can enter into either a buying or selling position, what we call double side trading. So, what are market opportunities and what exactly are you looking at? I'm going to explain this in the most simple way, but in reality there are many indicators and multiple factors that must be considered to provide a market opportunity. The text on the screen before you shows this, but I'm going to create my own example to make things easier to understand. Market opportunities are trading opportunities that our research department provide on a daily basis, according to market conditions. They are available to clients who have already made a deposit. They consist of fundamental analysis. A single example of one indicator to be considered would be if the Federal Reserve was to raise interest rates and how this could potentially affect the value of the dollar. Geopolitical events. A current geopolitical example would be the impact of the war of words between North Korea and the US and how that's impacting the markets. Or the war of words between China and the US and how that's impacting the markets. This would likely indicate volatility in those currency pairs involved. Technical analysis you can see on the right-hand side of your screen. And this includes the pivot point, which is a price level that is used as a possible indicator of market movement. A pivot point is calculated as an average of significant prices, that's high, low, and close, from the performance of a market in the prior trading period. Before that, you can see profit and loss calculations based on a one-lot trading volume. You can find a sample of a market opportunity like this one on our website. A market opportunity then consists of geopolitical events, fundamental analysis, and technical analysis. That was my introduction to Forex Basics. So now you have some understanding about trading and our market opportunity. Why not take the next step and call one of our account managers to inquire about moving from demo to a real trading account? And now would be a great time for me to talk about our special offer. If you open a real account to make a deposit within the next 48 hours, you will receive a 5% balance bonus on your first time deposit. The balance bonus is real money from the company budget, and you can use that money to trade with. The money itself can't be withdrawn immediately, but the profits you can make from it can be withdrawn after you trade a certain volume. It's a great offer, so why not try out our services and when you're ready, open a few positions. If anything is unclear to you or if you have any questions, you can ask an account manager to explain further. And of course, you can use our special offer to trade on one of our market opportunities if you choose. My next webinar on the advantages of trading CFDs with ForeTrade will explain everything you need to know about our company, trading, and perhaps most importantly, what you can do to make sure you have the greatest possible chance of trading successfully. That webinar will be next week on Wednesday, 23rd of April. Until then, I'll say goodbye and hope that you'll join us again at ForeTrade soon.